Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. And so tonight we are going to go over the 3 opening trades that we had, 2 brand new orders and 1 rolling order that we actually rolled a position from May expiration to June expiration. And then today we had no closing alert, so we're not going to go over any of those, obviously. Let's actually start tonight with the vertical roll of SLV, which is silver, and this trade right here, number 3 on our list tonight. So here's the deal. Silver, and I'm actually going to go to the chart of silver first, and then I'll come back. But silver, we were long a 1820 credit spread in silver. I'm sorry, debit call spread in silver, and so that put our break-even price for the month right around $19. Now, we still have a little bit of time to go between now and expiration, and silver is trending higher. So it is starting to rebound off of the lows, and we're starting to move higher. But at least at this point, with 10 days to go until May expiration, we're still very much in the area where silver could either make a lot of money or lose a lot of money just purely based on where the price ends up over the next couple days. So given that fact, we decided to roll the contract to the next expiration month. And when you do this with a debit spread, you actually want to roll the contract for as little of a debit as physically possible, right? You don't want to add or pay too much to roll that contract to the next month because you still have a long position and still originally a 50-50 bet. And if we can just extend out our trading timeline 1 more month, then that gives us an extra time to be right or wrong. Whatever the case is, at least we get some extra time to see some movement in silver. So what we ended up doing is we ended up rolling out our May option. So you can see our order was to buy 3 vertical rolls. So we actually ended up buying the June options, selling our May position, and we matched the exact same strikes for June and May. So we sold out of our 1820 call spread in May and bought the 1820 call spread for June. So exactly matching the strikes. Still puts our break-even price right around $19. And again, on this debit or on this roll, we only paid about 5 cents. So very, very tiny investment for getting a lot of extra time to be right in this trade. And again, the reason that we did this is not because we want to do this on every single debit spread that as we get closer to expiration, but this one is really, if you will, on the dance floor. So it's very close. The price of silver is very close to where our break-even price is. And we just purely want that extra time to be right or wrong, whatever the case is, but more time is better than less time. All right, so let's go over the opening trades today. The first one that we had was Home Depot. This one was sent closer to the end of the day, but it really was just selling a call spread against Home Depot and really kind of looking at the whole screen and saying, you know what, if the market's going to continue lower and we're seeing a lot of earnings that aren't too good and some selling pressure in the market, we obviously want to be a part of that and not be too tilted towards the bullish side. We've had a lot of bullish positions not only last week, but in the beginning of this week. So going to start adding a couple more bearish positions. Again, just trying to even out the portfolio overall. So in Home Depot, it had a really tough day. Implied volatility was up in the stock, however, and therefore we sold the 82.5 call spread for a $51 credit. Now, if we actually go to the chart here of Home Depot, you can see just how bad today was for Home Depot. It had a really tough day and was down in a big way. Now, Home Depot is one of those stocks that can actually move pretty quickly, but with implied volatility back above the 50th percentile and really no earnings on the horizon just yet until we get into next expiration month, we felt it was a good idea to at least get some position on here, and if we need to, we can turn this into an iron condor or something like that, or a butterfly later on, but at least we established the position. Now, by selling it at 80, that's our line in the sand, that's our first strike. Our break-even point is right around 80.50 because that's what we took in as a credit. So it actually puts us back above the recent highs for a break-even point. And that's really what we want to be concerned about, is that if Home Depot does turn around with the overall market, which would just be great for our overall portfolio anyway, but if Home Depot does turn around, we actually have quite a big bit of room between ourselves and the market to be wrong in Home Depot's direction going forward and still be right and be able to make money. So I think this was a really good trade. I'm very excited about it. As we get closer to earnings, I know implied volatility will probably continue to move higher, and at that point we can start to look at either hedging the position or just taking it off if the stock continues to move lower. All right, and then the last position that we made tonight is on WFM, which is Whole Foods. Now, Whole Foods had earnings after hours, and we had entered this position right before the end of the day, and it was a June iron condor in Whole Foods. So we went ahead and sold the 50-55 call spread, and then also went in and sold the 45-40 put spread. Now the combination of those two positions, we took in a credit of about 180. So actually a fairly decent sized credit for Whole Foods. Now here's what actually happened after the market closed today. Whole Foods did not have good earnings and has now gapped lower in a substantial way. So I'm actually going to go to the Analyze tab so that you guys can see where it's trading. And it's actually trading in the money in one of our positions. Now we've had this happen before in the past, and it's just a matter of actually, and I guess that's not a symbol. This is just a matter of the stock moving far beyond our strike prices, and you can see where our iron condor is now. So our iron condor was very wide, centered around where Whole Foods closed at the end of the day, but now you can see Whole Foods is trading down around 41.50 or so. So we'll see where it opens up tomorrow. It's been known to just turn around at the end of the day, on earnings day, and rally up or go down, whatever the case is. But considering that we already have this iron condor in place, our risk is defined on the downside. So we can't lose more than what we already have, but that doesn't mean that we can't adjust the position aggressively tomorrow. So what we'll end up doing is we'll actually end up tomorrow, and you'll see this order come out, but we will actually end up buying back our short call spread at 50 and 55 because that'll be essentially worthless, and we'll resell a new call position much closer to the market. So probably somewhere around 45.50 or so. And so that'll create this new profit loss diagram that looks a little bit more like this. So we'll actually shift this whole line over here, this whole profit side over here, and take in more credit without taking additional risk. So that's the whole key, is that we're going to kind of close out this top side trade, this call spread. We'll close that out, take a profit on that, and roll it down and closer to the market to take in more credit. And then so hopefully if Whole Foods does move back up higher, we have an opportunity to make money. And if it does continue lower, we're going to keep reducing our risk the whole way so that what is currently a loss becomes a smaller and smaller and smaller loss, and hopefully no loss at all. So that's the way that you have to adjust these things after earnings. And all too often, a lot of traders get afraid to make earnings trades because of this, right? Because the stock kind of moves outside of your bounds. And you really can't control that, right? But you have to have some skin in the game. As long as you keep your position size small, again, for us, there's only a 2 lot on each side, so it's a very small position for our overall portfolio. But this is something that we're going to manage aggressively. And at this point, we can make adjustments and reduce our risk overall, and even increase our potential for profit should Whole Foods kind of bounce between now and June. So we've got a ton of time between now and expiration. There's a lot we can do, and we'll keep updating everyone, obviously, with all of these trades. But the first trade to look for tomorrow, and I'm just talking through it with you guys tonight on the video because obviously the market's not open, but we would close out our call side and hedge or roll down our call side closer to the market to take in more premium. So as always, I hope you guys really enjoy these videos. We'll see what tomorrow brings for the stock market. I know it's been kind of crazy the last couple of days, just figuring out which direction the market's going to go. But at the end of the day, we don't know anyway, and all we have to do is make more trades and be better about managing our risk. As always, hope you guys enjoy these videos. Please add your comments or questions right below. I'll get back to all of those tonight or tomorrow before the open, and happy trading.